Hello everyone, welcome back to Just Invest Today. In today's video, we're talking about this new interview with Mohnish Pabrai and Guy Spier. It was amazing. A lot of good questions, a lot of good answers. Mohnish Pabrai keeps giving us these interviews. We're learning so much, gathering a lot of information and just helpful tips to become a better investor. I'm going to be going through the 3 questions that I really enjoyed the answers to. So let's get into this interview and let's talk about it. First question that was asked was talking about his early investment in 1995, his 100 bagger, and kind of why he likes value investing. And this was an amazing answer. This just shows you what value investing is about and how you find these amazing opportunities and just how you just have to take it and grab it. So he talks about in 1995, he actually had a $1 million. He was managing $1 million of capital and he wanted to dip his toe in India. He said he should have did a lot more. He should have invested a lot more in India. If he did that, oh my God, his returns would be crazy. Out of the $1 million, he invested $20,000 in India. And out of that $20,000, he only had $10,000 into this one investment called Satyam Computer Holdings. And he liked this company because he was in IT and he kind of knew the salespeople that were selling the product. So it was actually in his circle of competence perfectly. So this business was actually really cheap for him when he actually looked into it. The market cap of the business was selling less than the actual real estate ownership that it had. This was a no-brainer. Plus the earnings were growing 67% a year. So he invested that $10,000 into Satyam, and then he kind of just wanted to wait it out to see what would happen into the future. And then Satyam actually spun out another business during the whole dot-com boom. And during that whole dot-com boom and bust, Satyam went up 100x, man. So that is crazy. His 10,000 turned to like 1.2, $1.3 million. And then later on, actually, this investment turned out bad because they found out some fraud that was in the company and the owner was cooking the books, but this was way after he sold. So you can kind of see the asymmetric upside. He was buying a company less than its book value with a huge amount of growth. We always want to invest in these opportunities where the downside is basically nothing and we have a huge upside to the investment. And he's going to talk about this more later on. So the next question that I really enjoyed the answer to was, what is the difference between Warren and Charlie? And he goes on a little detour with this answer. It kind of really doesn't answer the question too much, but I love it because he wants to give his own thoughts into things. So he talks about 2 important mental models to have. We already know Mohnish Pabrai's amazing cloning model that he uses a lot. And then he talks about another mental model that he uses a lot. And the next one is asymmetry, which means that the downside is pretty much protected or just non-existent. And the upside is just unknown. It can be crazy amount of upside. So he gives an example of actually Jeff Bezos in Amazon and how Amazon was just throwing like paint on a wall. They were doing all these crazy innovative things like Alexia, like AWS, like phones, whatever it was. They put a lot of small bets into things and whatever takes off just grows like crazy. So he gives an example of that with Jeff Bezos. And then he gives the opposite example of Facebook, which is not a good asymmetry bet because downside is not really muted with the whole metaverse because the metaverse is costing so much money. So the upside is unknown, but the downside is huge because all that wasted money. So Facebook is not a good example of that, but the way Amazon does it is amazing in his book. And he talks about the dinner that he won with Warren Buffett and the charity. Now he thinks of that as a good asymmetry bet because the upside was just unknown and it wasn't a lot of downside because it was like 1% of his net worth. So it had a crazy amount of upside and the upside actually went over his expectations. He got to meet Charlie, he got to meet Warren Buffett's assistant, he got to meet all of Charlie's friends. So we had all of this amazing stuff just going into that dinner. So we want to look at that in our life. Like, where is the asymmetry? Like, where can we go where the upside is just unknown and the downside is like nothing or it's just muted? And then he also talks about some critical thing that Charlie Munger does. Charlie Munger actually likes to put randomness in his life. So he gets all these letters, he gets all this mail, and sometimes he just opens it up, like opens 1 or 2 things. And he's been doing this over the years. What has happened is actually that he's actually met a couple of friends and a couple of business partners just opening up random letters that people sent to him. So he likes to introduce randomness into his life. I think this is like a good kind of model to have, which I might use, which is pretty interesting. So the last question that I really enjoyed the answer to was amazing. It's all about portfolio concentration. And he talks about how he invests. He invests a maximum of 10% into one position. He usually has a 10 by 10 portfolio. And then he talks about Rakesh, an amazing investor in India. He recently passed away at like age 60 or early 60s. He ended up with $6 to $8 billion. And that came from pretty much one company, Titan, which he put 4% in a decade or like couple decades ago. Rakesh never managed money. He had less than 500 to his name. When he started his career, he didn't live that long. When he passed away, he had 6.8 billion, no fees, never ran a business, all passive investments. Half of the money was just from one company. He made a 4% bet a few decades ago in Titan Industries in India. It ended up becoming more than half of his portfolio. Titan has done extremely well and continues to do well. If the other 90% of his portfolio went to zero, he would still end up with around 3 billion. We start off not that concentrated, but if the job is done right, we will end up concentrated. One of the things that scratches my head about is that these smart investors will buy MasterCard after its IPO. MasterCard starts at 5% position, it does very well, becomes 20 to 30% of the position, does better than everything else. Like Jack Nicholson said, you can't handle the truth. It gets to 50% and then they trim, it gets to 70% again, and then they trim again, and it never gets to 20%. I scratch my head about that. You're cutting the flowers and watering the weeds. That's a Peter Lynch quote directly. I think if an investment manager done the job right, they will end up with 80% of the net worth in one stock. Example, Walmart. The Waltons own 90% concentrated in one stock. Nick Sleep, Amazon, 80% of his portfolio. Just leave it alone if it's a great business. Honestly, that's so easy to say, but man, can you imagine that? It's so hard to do, and he gives props to Rakesh for actually being able to hold it for that long. Just hold it, watch the company. If its sales are growing, if its earnings are growing, just hold the company, guys. So that's it for this video. Tell me what you think. There was a lot more questions answered, but these are the 3 main things I took away from it. So guys, like it, subscribe to my channel. Peace.